Then this new money created by the Fed is multiplied by a factor of 10 by the banks thanks to the fractional reserve principle. So although the banks don't create currency, they do create checkbook money or deposits by making new loans. They even invest some of this created money. In fact, over $1 trillion of this privately created money has been used to purchase U.S. bonds on the open market, which provides the banks with roughly $50 billion in interest, risk-free, each year, less the interest they pay to some depositors. In this way, through fractional reserve lending, banks create over 90% of the money and therefore cause over 90% of our inflation. What can we do about all this? Fortunately, there's a way to fix the problem fairly easily, speedily, and without any serious financial problems. We can get our country totally out of debt in 1 to 2 years by simply paying off these U.S. bonds with debt-free U.S. notes, just like Lincoln issued. Of course, that by itself would create tremendous inflation, since our currency is presently multiplied by the fractional reserve banking system. But here's the ingenious solution, advanced in part by Milton Friedman, to keep the money supply stable and avoid inflation and deflation while the debt is retired. As the Treasury buys up its bonds on the open market with U.S. notes, the reserve requirements of your hometown local bank will be proportionally raised, so the amount of money in circulation remains constant. As those holding bonds are paid off in U.S. notes, they will deposit this money, thus making available the currency then needed by the banks to increase their reserves. Once all the U.S. bonds are replaced with U.S. notes, banks will be at 100% reserve banking instead of the fractional reserve system currently in use. From this point on, the former Fed buildings will only be needed as a central clearinghouse for checks and as vaults for U.S. notes. The Federal Reserve Act will no longer be necessary and could be repealed. Monetary power can be transferred back to the Treasury Department. There would be no further creation or contraction of money by banks. By doing it this way, our national debt can be paid off in a single year or so, and the Fed and fractional reserve banking abolished without national bankruptcy, financial collapse, inflation or deflation, or any significant change in the way the average American goes about his business. To the average person, the primary difference would be that for the first time since the Federal Reserve Act was passed in 1913, taxes would begin to go down. Now there's a real national blessing for you, rather than for Hamilton's banker friends. Now let's take a look at these proposals in more detail. Here are the main provisions of a Monetary Reform Act which needs to be passed by Congress. We've drafted a proposed Monetary Reform Act which follows at the end of this tape. Of course, variations with the same results would be equally welcome. 1. Pay off the debt with debt-free U.S. notes. As Thomas Edison put it, if the U.S. can issue a dollar bond, it can issue a dollar bill. They both rest purely on the faith and credit of the United States government. This amounts to a simple substitution of one type of government obligation for another. One bears interest, the other doesn't. Federal Reserve notes could be used for this as well, but could not be printed after the Fed's abolished as we propose, so we suggest using U.S. notes instead. 2. Abolish fractional reserve banking. As the debt is paid off, the reserve requirements of all banks and financial institutions would be raised proportionally at the same time to absorb the new U.S. notes, which would be deposited and become the bank's increased reserves. Towards the end of the first year of the transition period, the remaining liabilities of financial institutions would be assumed or acquired by the U.S. government in a one-time operation. In other words, they too would eventually be paid off with debt-free U.S. notes in order to keep the total money supply stable. At the end of the first year or so, all of the national debt would be paid, and we could start enjoying the benefits of full reserve banking. The Fed would be obsolete, an anachronism. 3. Repeal the Federal Reserve Act of 1913 and the National Banking Act of 1864. These acts delegate the money power to a private banking monopoly. They must be repealed and the money power handed back to the Department of Treasury where they were initially under President Abraham Lincoln. No banker or person in any way affiliated with financial institutions should be allowed to regulate banking. After the first two reforms, these acts would serve no useful purpose anyway, since they relate to a fractional reserve banking system. 4. Withdraw the U.S. from the IMF, the BIS, and the World Bank. These institutions, like the Federal Reserve, are designed to further centralize the power of the international bankers over the world's economy, and the U.S. must withdraw from them. Their harmless functions, such as currency exchange, can be accomplished either nationally or in new organizations limited to those functions. Such a monetary reform act would guarantee that the amount of money in circulation would stay very stable, causing neither inflation nor deflation. Remember, for the last 3 decades, the Fed has doubled the American money supply every 10 years. That fact and fractional reserve banking are the real causes of inflation and the reduction in our buying power, a hidden tax. These and other taxes are the real reasons both parents now have to work just to get by. The money supply should increase slowly to keep prices stable, roughly in proportion to population growth, about 3% per year, not at the whim of a group of bankers meeting in secret. In fact, all future decisions on how much money will be in the American economy must be made based on statistics of population growth and the price level index. The new monetary regulators and the Treasury Department, perhaps called the Monetary Committee, would have absolutely no discretion in this matter except in time of declared war. This would ensure a steady, stable money growth of roughly 3% per year, resulting in stable prices and no sharp changes in the money supply. To make certain the process is completely open and honest, all deliberations would be public, not secret, as meetings of the Fed's Board of Governors are today. How do we know this will work? Because these steps remove the 2 major causes of economic instability, the Fed and fractional reserve banking, and the newest one as well, the BIS, Bank of International Settlements. But most importantly, the danger of a severe depression would be eliminated. Let's listen to Milton Friedman on the single cause of severe economic depressions. I know of no severe depression in any country or any time that was not accompanied by a sharp decline in the stock of money, and equally of no sharp decline in the stock of money that was not accompanied by a severe depression. Issuing our own currency is not a radical solution. It's been advocated by Presidents Jefferson, Madison, Jackson, Van Buren, and Lincoln. But it's been used at different times throughout Europe as well. Perhaps the best example is one of the small islands off the coast of France in the English Channel. Called Guernsey, it's been using debt-free money issues to pay for large building projects for nearly 200 years. Here we are on Guernsey, and this is the Guernsey Flower and Vegetable Market. Guernsey is one of the most successful examples of just how well a debt-free money system can work. In 1815, a committee was appointed to investigate how best to finance this new market. The impoverished island could not afford more new taxes, so the state's fathers decided to try a revolutionary idea: issue their own paper money. They were just colorful paper notes, backed by nothing, but the people of this tiny island agreed to accept them and trade with them. To be sure they circulated widely, they were declared to be good for the payment of taxes.